Hey everyone, welcome back to Corporate Decoder, the place where we sift through mind-numbing corporate filings so you don't have to. Today, we're diving into the Federal Home Loan Bank of San Francisco's 10Q report. It's about as exciting as watching paint dry, unless you're into super complex banking regulations, but don't worry, we'll make it interesting somewhat. This quarter, it seems like the bank took a bit of a financial dip. Was it a rogue wave in the San Francisco Bay, or just the usual ebb and flow? Let's decode it. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. First things first, let's check the basics. Total assets, the big pile of everything they own, clocked in at around $78 billion in March. That's a drop from almost $82 billion at the end of last year. So they have fewer assets. One of the major reasons for this change is the value of their advances. Think of advances like loans they've given out. Those are down a whopping almost $8 billion. A big dip from almost $46 billion to under $38 billion. But it's not all bad news. Available for sale securities, which is government bonds, agency, and private label mortgage bonds, actually went up from around $35 billion to almost $39 billion. So they moved away from lending to investments. Okay, now let's talk about the income statement. Interest income from advances took a nosedive, dropping from $759 million to $479 million. That's a huge difference. But it wasn't all doom and gloom. Their income from securities actually went up in the same period from $23 to $268 million. Of course, all this interest income has to be balanced against interest expense, which, decreased also from $850 million to $594 million. They also made a provision for credit losses of $1 million, where in the same period last year they reversed $4 million. It's not ideal, but it also shows that they're being conservative. Digging into the other income section, we see there was a swing in net gantraculos on advances and consolidated obligation bonds by about $43 million, sex $29 million gain from $14 million loss. Also, the company benefited last year with some extra cash, with $30 million coming from a termination of long-term funding arrangement, with nothing similar this year. Finally, they increased voluntary housing and community investment contributions, almost doubled them from $4 million to $10 million, which might hurt their bottom line but is good for PR. At the end of all that, the company ended up with $94 million for the quarter, which is still very healthy. Let's talk stock. We had some small changes with stock. That's mostly because this stock can be puttable. So people sell and buy the stock as they have needs for doing it for their loans. These were mostly offset with no major impact. There was a $55 million hit due to cash dividend payments. Looking at the cash flow statements from operations activities, it looks like the company overall used $32 million compared to a positive cash flow of $268 million the previous year. This was completely reversed, however, with higher net cash provided by investing activities going from $4.4 billion. The swings mostly happened due to management of investments, including interest-bearing deposits, securities, and a mix of payments for and proceeds from advances. Finally, financing was the major drain on funds, with $3.9 billion BOS bonds and discount notes. Overall, these changes in cash flowed to a net increase of $6 million in cash for the bank. This left the company with a final $8 million in cash. Of course, no report is complete without a list of all the things that could go wrong. These include the usual suspects, market conditions, political and regulatory changes. It's a laundry list of potential headaches. On the bright side, there aren't any major legal battles looming, so that's one less thing to worry about. Management thinks their financial reporting is great. There were no issues that needed addressing. What's the verdict here? It seems like the Federal Home Loan Bank of San Francisco had a decent but not spectacular quarter. The big asset and profit dip is concerning. A lot of the swings were mostly about asset management of capital, and the lower lending to members is definitely something to keep an eye on. Their capital position seems strong, but we can't really get a lot of conclusions from just a single quarter. The company is doing pretty well given the circumstances. Alright, that's our breakdown of Federal Home Loan Bank of San Francisco's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.